Welcome to the news briefing. We start with a massive shakeup in the sci-fi world. HBO has officially called it quits on Westworld. Creators Jonathan Nolan and Lisa Joy had hoped for a final loop, but Warner Bros. Discovery has permanently closed the park on the television cast, opting instead to greenlight a brand new feature film reboot. Screenwriter David Koepp is stepping in to bypass all the complex lore, diving straight back into the original 1973 film to create a theatrical blockbuster, completely erasing the storylines of Dolores, Maeve, and the Man in Black. This move signals a total end for the TV iteration of the franchise and sets the stage for a completely different cinematic universe. Next up, productions, and he is deeply concerned about potential changes to editorial independence at CBS and CNN if the merger goes through. He is urging Hollywood agencies to take a stronger stand now. And finally, we look at the bigger picture for investors. Warner Bros. Discovery remains a key barometer for U.S. consumer media consumption, with its performance reflecting trends in streaming adoption versus traditional cable. While the stock shows a strong rebound, analysts remain divided with a consensus hold rating, leaving U.S. investors to weigh the company's earnings risks against its strategic push into direct-to-consumer growth. Stay with us to see how these major shifts impact your portfolio. HBO's prestige science fiction series Westworld is officially dead, with hopes for a Season 5 revival completely extinguished by a major studio pivot. Warner Bros. Discovery has permanently closed the television park, choosing instead to greenlight a brand new feature film reboot, effectively ending the existing television iteration of the franchise. The decision marks a definitive end to the series' narrative arc. By fast-tracking a new theatrical movie written by David Koepp, the studio is bypassing the unresolved cliffhangers of the 2022 finale and retiring the complex storylines involving characters like Dolores, Maeve, and the Man in Black. This move signals a shift away from the intricate lore of the HBO series toward a new cinematic venture. For nearly 4 years following the abrupt cancellation in November 2022, the dedicated fan base believed a conclusion was possible. Creator Jonathan Nolan had hinted as late as 2024 that he intended to finalize the story's architecture. However, corporate restructuring, streaming economics, and the announcement of a new cinematic universe have permanently blocked any Season 5 revival. The ultimate blow came with the confirmation that a new Westworld movie is actively in development. Screenwriter David Koepp is intentionally ignoring the complex 4-season continuity of the HBO show, instead drawing inspiration directly from Michael Crichton's original 1973 sci-fi film for a theatrical remake. Warner Bros. Is prioritizing financial resources on a broad, accessible blockbuster, overfunding a niche, highly complicated conclusion to an unfinished television series. Narratively, the franchise was in a difficult position heading into the finale. Season 4 concluded with the total extinction of the human race, leaving sentient life confined to a digital sandbox controlled by Dolores. While Nolan envisioned Season 5 looping back to the Western aesthetic of Season 1 within this simulation, Network executives reportedly viewed a narrative centered on AI playing a game with AI as a difficult, low-margin sell for general audiences. Furthermore, the series suffered from its own massive scale. Production costs exceeded $100 million per season, while linear viewership had significantly declined. Compounding these issues, Warner Bros. Discovery purged the series from its streaming library to reduce tax liabilities and residual payouts. The logistical challenge of reassembling the star-studded cast became impossible as key actors moved on to other high-profile projects. Consequently, viewers seeking the series must navigate third-party platforms for existing episodes, with the show no longer available on standard streaming services like Jio Cinema in India. International viewers can still purchase or rent the complete four-season run through premium video on-demand platforms such as iTunes and Apple TV. Warner Bros. Discovery stock is facing renewed scrutiny following a significant quarterly earnings miss, juxtaposed against a powerful one-year stock rebound of approximately 190%. The latest volatility on the Nasdaq is driven by the tension between disappointing quarterly results and the company's long-term strategic positioning in media and streaming. Warner Bros. Discovery operates as a diversified content and distribution powerhouse, integrating legacy cable networks, a major Hollywood studio, and a growing streaming operation. The portfolio includes key brands such as Warner Bros. Pictures, HBO, Discovery Channel, and CNN, linking the company closely to structural shifts in how Americans consume news, sports, and entertainment. Streaming remains a central pillar of the strategy, anchored by the flagship Max service, which combines premium HBO content with Warner Bros. Films and Discovery unscripted programming to drive subscriber growth. Concurrently, the company manages traditional pay TV networks that generate affiliate revenue but are contending with cord-cutting pressures, creating a complex earnings profile. The most recent quarter revealed this complexity. While revenue aligned with consensus estimates, the company posted a loss of about $1.17 per share, substantially wider than the expected loss of roughly $0.1. This was attributed to restructuring charges, interest costs, and content amortization, resulting in a negative net margin of approximately 4.7%. Despite the recent earnings disappointment, the stock has staged a remarkable recovery over the past 12 months, achieving a total shareholder return of roughly 190% according to some analyses. However, recent trading data shows modest year-to-date weakness. Analyst sentiment remains divided, with a consensus rating of hold and a 12-month price target near the current trading level, suggesting analysts view the near-term outlook as balanced. Some valuation-focused services have flagged the stock as potentially overvalued relative to sector peers. Institutional investor activity is also notable, with some asset managers reportedly reducing their holdings following the earnings miss, indicating a reassessment of the company's deleveraging progress and content strategy. For U.S. investors, Warner Bros. Discovery serves as a barometer for broader media trends, sensitive to macroeconomic data, advertising budgets, and regulatory developments concerning media consolidation and content ownership. The company's performance is viewed through a lens combining cyclical revenue drivers like advertising and box office receipts with the multi-year secular trend of streaming adoption. Actor Mark Ruffalo has escalated his opposition to Paramount's proposed acquisition of Warner Bros. Discovery, asserting that he is now a target for speaking out against the deal. In an interview with Deadline, Ruffalo noted that initially, many in Hollywood hesitated to oppose the merger due to fears of retaliation from the Ellison family, who are connected to the takeover. However, he stated that support for the anti-merger campaign has been growing rapidly. Ruffalo reported that an open letter opposing the deal garnered approximately 2,000 new signatures in the last month, pushing the total close to 5,000. He attributed this momentum to supporters who are either financially stable enough to speak out or are fighting to safeguard their careers in the entertainment industry. The actor warned that major media mergers frequently result in significant job losses and the cancellation of productions. Drawing parallels to the earlier Fox-Disney merger, Ruffalo cautioned that similar negative consequences could materialize if Paramount successfully acquires Warner Bros. Discovery. Furthermore, Ruffalo voiced serious concerns regarding media ownership and editorial independence. He expressed apprehension that the Ellison family could gain sway over both CBS and CNN, potentially leading to political pressure on journalism. Citing instances such as CBS featuring Israeli Prime Minister Benjamin Netanyahu on 60 Minutes, Ruffalo suggested these appearances signaled shifting media dynamics. While acknowledging the inherent risks of public opposition and admitting to some fear, Ruffalo firmly stated that remaining silent was not an option. He issued an urgent call for Hollywood agencies and labor unions to adopt a more assertive stance against the proposed merger, warning that their clients and workers face jeopardy if they fail to act. The debate surrounding the merger intensified earlier this year, following reports that Netflix withdrew from negotiations involving Warner Bros. Discovery and declined to counter Paramount's guidance's reported $31 per share offer. Warner Bros. Discovery stock is facing a complex investor outlook, balancing a significant quarterly earnings miss against a powerful one-year share price rally. Following the release of recent results, the media group reported a quarterly loss of approximately $1.17 per share, substantially exceeding Wall Street expectations of a loss closer to $0.1 per share, despite revenue generally matching forecasts. This earnings pressure is keeping investors cautious. Conversely, the stock has experienced a dramatic rebound, achieving a roughly 190% one-year total shareholder return. As of mid-May 2026, the shares were trading in the high 20s on Nasdaq, reflecting strong investor sentiment regarding the company's recovery. Warner Bros. Discovery operates as a diversified media and entertainment conglomerate, encompassing television networks, film and television studios, and direct-to-consumer streaming platforms like Max and Discovery-branded offerings. Revenue streams are diversified, including affiliate fees and advertising from linear TV, income from film and series production and distribution, and growth opportunities in subscription and advertising-supported streaming. The company is strategically emphasizing a shift towards streaming, consolidating content under the Max brand to counter the decline in traditional linear television viewership. Furthermore, the group leverages valuable intellectual property, including major franchises, and manages costs through synergy and debt reduction initiatives following its recent corporate restructuring. For U.S. investors, the stock's current valuation remains subject to debate. While the share price recovery is notable, a consensus hold rating and a 12-month price target near $26.36 suggest limited immediate upside. Investors are currently weighing the volatility of recent earnings against the strong historical performance and the long-term execution of the transition from linear to direct-to-consumer revenue models. Key factors influencing the stock's risk-reward profile include the performance of content releases, subscriber growth on streaming platforms, and the ongoing success of cost-cutting measures.